Welcome to our mini webinar on the changes to the tax rate structure under the Tax Cuts and Jobs Act. My name is Steve Boisvert and I'm a CPA with Gelman, Rosenberg Freedman. These rate changes typically receive the most coverage anytime we have a new tax law. So let's take a look at how they've changed and the effect this may have on you in the coming tax year. So let's do a little analysis on the 2017 versus the 2018 tax rates. And we're just going to take into consideration two filing categories, single and married filing joint. Later on, we'll have a slide that shows you all the rates for 2018 for head of household, married filing separate. But for the sake of this comparison, we're just going to do the most common filers, which is single and married filing joint. Notice that there's going to be pretty much two different places there can be changes. The actual bracket where the tax rate is applied, and then the actual tax rate. So a good example here is this particular taxable income bracket went up $200 for this first section. The tax rate didn't change, but more income is captured by the 10% taxable income bracket. And then you'll see the rate changed 3%, dropped 3% for income in this range, dropped 3% for income in this range. And really, for the most part, the tax rates drop for everything except for this $200,000 to $500,000 tax range. Now notice, most of the $200,000 to $500,000 under the old tax structure was at a 33% rate. Now all of the $200,000 to $500,000 rate is 35%. So it's good, 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 and then bad, and then good, if I can say it like that. And the same goes for married filing joint. Everything is good until we get to this rate, and then better. So the question is, do you take a tax hit because of the expanded coverage of the 35% tax bracket? And the answer is not necessarily. And this is where you need to understand the difference between the marginal brackets and your effective tax rate. So will our client be affected by the change in the tax rate? So well, the answer is yes. Will it be beneficial? And the answer is it depends, as is every question, every answer to a tax question. So we have, the best we can do is give you an example of how it works, and then you can kind of decide for yourself, or you can get in touch with us. In our fact pattern, we have a married filing joint individual in 2018. Their taxable income is $350,000. We know that the $350,000 taxable income falls into the 32% bracket. Now, if you look at a tax table, up to this point, the tax on $315,000 is $64,179. The next dollar, so $315,001, this $1 is going to be taxed at the 32% bracket. And so on and so forth until you reach $350,000. Now the difference between $350,000 and $315,000 is $35,000. So $35,000 is going to be taxed at this 32% bracket. So if I was going to do an effective rate calculation, we would say $64,000, which is our tax on $315,000 from the 10, 12, 22, and 24% brackets, plus 32% times the difference of $350,000 and $315,000 divided by $350,000 taxable income. And this works out to 21.54%. This is your effective tax rate. Compare the 2154 to your marginal rate. This is your actual tax rate. And this is the bracket you're in. So yeah, that 35% bracket has become less advantageous than it was in the previous, but each of these, this is the same. This is 3% less, 3% less, 4% less. And all of these are taken into account before you get to 32% and 35%, which is going to be the only bracket that expanded. I'm not going to spend a huge amount of time on this particular slide. If you look back at slide 2, I mentioned that we would have a slide in here that shows all the rates. We did not show a slide for head of household or married filing separate. So this is just for your own edification. This slide is incorrect in this one spot here. It should say 500,000, not $5 million. All right, I'm not going to go through this entire slide. If you would like to analyze the slide, you can pause the video and take a look. Instead of doing a set fact pattern for this example, I figured we would try and give you a dispersion of different taxable incomes and the effect that Tax Cuts and Jobs Act may have on your income level. But keep in mind, tax is calculated on the taxable income, not on total income or on adjusted gross income. So taxable income is going to be income after all deductions have been accounted for. We've done a lot of mini webinars on different tax deductions that affect taxpayers. If everything holds constant from one year to another, it's likely your taxable income is going to change from year to year. And this is because of changes like AGI thresholds, changes to the itemized deductions, changes to the standard deduction. Maybe you're self-employed and you get the new qualified business income deduction, the 20% deduction, and we could go on and on. Maybe you got the state and local tax deduction last year on your itemized deductions, and now all of that's capped at $10,000. That could really impact your taxable income. So this slide should help you understand the change in tax rates if taken in a vacuum, but in the real world, nothing happens in a vacuum. So if by some chance you have the same taxable income in 2018 that you had in 2017, this could be the effect of the change. The other thing to note is that these calculations do not take into account AMT. Add backs from 2017 AMT would greatly impact your tax. Add backs that you would see would be something like the state and local tax deduction. And if you fall into the right income threshold, you could end up with a large AMT adjustment in 2017 that you're not going to have in 2018. So all of those things are things to consider while you're looking at this. But this is the single. We only went through single and married filing joint. This is the tax, and this is the effective rate. So if this is something that interests you, you can take a look here. If we're hitting an income level that doesn't really affect you, you can always go to a website. There are a number of tax calculator websites that you can punch your numbers in and play around with it. So I hate to give you a ton of writing on one slide, but this is my catch-all for any other tax rates that are really worth noting. And the first of them is the capital gains tax rate. So capital gains is going to be a capital gains tax going to be applied to any tax that is on qualified dividends or on long-term capital gains. Short-term capital gains are going to be taxed at ordinary income tax rates. A long-term capital gain is any gain on an asset that's been held, a capital asset that's been held for longer than 1 year. As you can see, we've got 3 different rates. 0% is going to apply to these taxable incomes if your taxable income is less than these amounts, then you're going to be taxed at 0% on any kind of capital gain income that you have, so long as that capital gain is a long-term capital gain or the dividend is a qualified dividend. Now, anything north of these is going to be taxed at 15%, and anything north of these taxable incomes is going to be taxed at 20%. Now, the net investment income tax is a 3.8% investment income tax that it came in with the Affordable Care Act, and you're only going to see net investment income tax when you have modified adjusted gross income over $250,000 for joint, $125,000 for married filing separate, and $200,000 for singles and head of household. I could get into the calculation for the net investment income tax, but I think for purposes of this presentation, what you need to know is if you're over this modified gross income, adjusted gross income, you could be subject to a 3.8% tax if you have investment income, anything like dividends, interest, capital gains, etc. The final taxes, the Social Security and Medicare tax. Social Security is still taxed at 6.2%. This hasn't changed. The wage limit is what goes up. So more of your income will be captured by a 6.2% Social Security tax rate. Medicare is going to be taxed. There's no wage limitation, but there is an increase of 0.9% when your wages exceed $200,000. And what you'll find is that your employer is required to withhold the additional 0.9% whenever you get over that $200,000. Well, that's all for our topic today. For other mini webinars, please go to our website, www.grfcpa.com. You can underline, or you can click resources and then on demand, and that'll take you to other content that we have. If there's a topic that interests you that you'd like more information on, please feel free to contact us. We'd like to create many webinars on topics that interest people, so definitely reach out. And I can be contacted at espoivre@grfcpa.com. My extension is 671. You can call the main line there, 301-951-9090, and dial my extension. You'll get me. Thanks again for watching.